Good morning. It is a real pleasure to have with us today Vice Chairman Richard Clarida from the Federal Reserve. He was confirmed as Vice Chairman on August 28th by a veritable landslide of 69-26. He assumed office on September 17th, so we have called him again very early in his tenure. Very few people have joined the board better equipped both by intellect and expertise to take on the important work that it entails. After receiving his PhD from Harvard University, Vice Chairman Clarida served as a senior staff advisor at the White House Council of Economic Advisors, and then joined the faculty at Columbia University, where he rose to chair the Department of Economics. He conducted pioneering research on dynamic, stochastic, general equilibrium modeling with major implications for monetary policy. He left Columbia to serve as Assistant Secretary of the Treasury for Economic Policy, serving as the principal economic advisor of both the Secretaries Paul O'Neill and John Snow. Vice Chairman Clarida then took a turn in the private sector, consulting for the Global Foreign Exchange Group at Credit Suisse and Grossman Asset Management. He then became a strategic advisor with PIMCO and was appointed as manager director of the firm. Meanwhile, he continued his academic pursuits, publishing regularly on a variety of topics. Thus, as a successful academic, policymaker, and market participant, Vice Chairman Clarida brings useful perspectives and a practiced eye to important issues, monetary and regulatory, currently facing the Federal Reserve. It is my pleasure to introduce him to you.
Thank you for that kind introduction. I'm delighted to be speaking at this annual conference of the Clearinghouse and the Bank Policy Institute. Looks like a fabulous program. Today I will discuss recent economic developments and the economic outlook before going on to outline my thinking about the connection between data dependence and monetary policy. And I will close with some observations on the implications for U.S. monetary policy that flow from this perspective. U.S. economic fundamentals are robust, as indicated by strong growth in GDP, and a job market that has been surprising on the upside for nearly 2 years. Smoothing across the first 3 quarters of this year, GDP growth is averaging 3.3%. Private sector forecasts for the full year suggest that growth is likely to equal or perhaps slightly exceed 3%. If this occurs, GDP growth in 2018 will be the fastest recorded so far during the current expansion, which in July entered its 10th year. If, as I expect, the economic expansion continues in 2019, this will become the longest U.S. expansion in recorded history. Likewise, the labor market remains healthy. Average monthly job gains continue to outpace the increase needed to provide jobs for new entrants to the labor force over the longer run, with payrolls rising by 250,000 in October. And at 3.7%, the unemployment rate is the lowest it has been since 1969. In addition, after remaining stubbornly sluggish throughout much of the expansion, nominal wage growth is picking up, with various measures now running in the neighborhood of 3% on an annual basis. The inflation data in the year-to-date for the PCE price index has been running at or close to our 2% objective, including on a core basis. While my base case is for this to continue, it is important to monitor measures of inflation expectations to confirm that households and businesses expect price stability to be maintained. The median of expected inflation 5 to 10 years in the future from the University of Michigan surveys is within, but I believe at the lower end of the range consistent with price stability. Likewise, inflation readings from the TIPS market indicate to me that financial markets expect the CPI inflation rate to be about 2%. That said, historically, PCE inflation has averaged about 0.3% below CPI inflation. And if this were to continue, the readings from the TIPS market would indicate that expected PCE inflation is running somewhat less than 2%. Now, what might explain why inflation is running close to the Fed's 2% objective and not well above it when growth is strong and the labor market is robust? According to the BLS, productivity growth in the business sector, as measured by output per hour, is averaging 2% at an annual rate this year, while aggregate hours worked in the business sector has risen at a pace of 1.8% through the third quarter. This decomposition indicates that growth rates of productivity and hours worked in 2018 have been exceeding their estimated longer-run trends by the Congressional Budget Office. In other words, while growth in aggregate demand in 2018 has been above the expected long-run growth in aggregate supply, it has not been exceeding this year's growth in actual aggregate supply. Now, ultimately, hours growth will likely converge to a slower pace because of demographic factors. But how rapidly this happens will depend in part on the behavior of labor force participation. In recent years, developments suggest there may be still some further room for participation rates in the job market, especially in the prime age group 25 to 54, to rise. Labor participation by prime-age women has increased around 2 percentage points in the past 3 years and is now at the highest level in a decade. That said, it is still a percentage and half of a point below the peak level reached in 2000. Labor force participation among 25 to 54-year-old men has risen by roughly one percentage point in the past several years. But it is still 2 percentage points below the level seen a decade ago, and it is 3 percentage points below the levels that prevailed in the late 1990s. As for productivity growth, there is considerable uncertainty about how much of the rebound in productivity growth that we have seen in recent quarters is cyclical and how much is structural. I believe that both factors are at work. The structural or trend component of productivity growth is a function of capital deepening through business investment, as well as a component sometimes referred to as the solo residual. Initial estimates from the recent GDP release indicate that equipment and software investment in the third quarter moderated from the rapid pace recorded in the first half of this year. Now, one data point does not make a trend, but an improvement in business investment will be important if the pickup in productivity growth that we have seen in recent quarters is to be sustained. As for the economic outlook, in the most recent summary of economic projections that the Fed released in September, the median projection for real GDP growth was 3.1% in 2018 and 2.5% in 2019. The unemployment rate was expected to decline to 3.5% next year, and total PCE inflation was expected to remain near 2%. With a robust labor market and inflation at or close to our 2% goal, and based upon the economic outlook that I have just laid out, I believe that monetary policy at this stage of the economic expansion should be aimed at sustaining growth and maximum employment at levels consistent with our inflation objective. At this stage of the interest rate cycle, I believe it will be especially important to monitor a wide range of data as we continually assess and calibrate whether the path for policy is consistent with meeting our dual mandate objectives on a sustained basis. Economic research suggests that monetary policy should be data dependent. And indeed, central banks around the world, including the Fed, often describe their policies in this way. I would now like to discuss how I think about two distinct roles that data dependence should play in the formulation and communication of monetary policy. It is important to state up front that data dependence is not, in and of itself, a monetary policy strategy. A monetary policy strategy must find a way to combine incoming data and the model of the economy with a healthy dose of judgment and humility to formulate and then communicate a path for the policy rate most consistent with our policy objectives. In the case of the Fed, those objectives are assigned to us by the Congress, and they are to achieve maximum employment and price stability. Importantly, because households and firms must make long-term saving and investment decisions, and because these decisions depend upon expected future path for the policy rate, the central bank should find a way to communicate and explain how incoming data are or are not changing the expected path for the policy rate consistent with best meeting its objectives. Absent such communication, inefficient divergences between public expectations and central bank intentions for the policy path can emerge and persist in ways that are costly to the economy when reversed. Now, within this general framework, let me now consider two distinct ways in which I think that the path for the federal funds rate should be data dependent. U.S. monetary policy has for some time and will, I believe, continue to be data dependent in the sense that incoming data reveal at the time of each meeting where the economy is at the time of that FOMC meeting relative to the goals of monetary policy. This information on where the economy is relative to the goals of policy is an important input to the policy decision. If, for example, incoming data in the months ahead were to reveal that inflation and inflation expectations are running higher than projected at present and in ways that are inconsistent with our 2% objective, then I would be receptive to increasing the policy rate by more than I currently expect will be necessary. Data dependence in this sense is easy to understand, as it is of the type implied by a large family of policy rules in which the parameters of the economy are known. But what if the key parameters that describe the long-run destination for the economy are unknown? This is indeed the relevant case for the FOMC and other central banks that they face in practice. The two most important unknown parameters needed to conduct and communicate monetary policy are the rate of unemployment consistent with maximum employment, sometimes called U-star, and the riskless real rate of interest consistent with price stability, called R-star. As a result, in the real world, monetary policy should, I believe, be data dependent in a second sense, that incoming data can reveal at each FOMC meeting signals that will enable the committee to update its estimates of R-star and U-star in order to obtain its best estimate of where the economy is heading. And indeed, as indicated in the SEP over the years, FOMC participants have, over the past 7 years, revised their estimates of both U-star and R-star substantially lower as unemployment fell and real interest rates remained well below prior estimates of neutral, without the rise in inflation or inflation expectation those earlier estimates would have predicted. And these revisions to U-star and R-star almost certainly did have an important influence on the path for policy that was actually realized in recent years. I would expect to revise my estimates of R-star and U-star as appropriate if incoming data on future inflation and unemployment diverge materially and persistently from my baseline projections today. So what does this mean for the conduct of monetary policy? As the economy has moved to a neighborhood consistent with the Fed's dual mandate objectives, risks have become more symmetric and less skewed to the downside than when the current rate hike cycle began 3 years ago. Raising rates too quickly could unnecessarily shorten the expansion, while moving too slowly could result in the rise in inflation expectations down the road that would be costly to reverse, as well as potentially pose financial stability risks. Although the real federal funds rate today is just below the range of longer-run estimates presented in the September SEP, it is much closer to the vicinity of R-star than it was when the FOMC started to remove accommodation in December of 2015. How close is a matter of judgment, and there's a range of views on the FOMC. As I have already stressed, R-star and U-star are uncertain, and I believe we should continue to update our estimates of them as new data arrive. This process of learning about R-star and U-star as new data arrive supports the case for gradual policy normalization, as it will allow the Fed to accumulate more information from the data about the ultimate destination for the policy rate and the unemployment rate at a time when inflation is close to our 2% objective. Thank you very much.
So thanks very much. So I thought I'd start, since you're still relatively new to the Federal Reserve and the board, just to try to get some of your initial impressions, also known as softball questions to get started. So just first sort of obvious question, I mean, you obviously spent a lot of time as an economist and an investor watching the Fed. What do you wish you'd known back then that you know now after 2 months?
I think I'd point to a couple of things. The first is the luxury that I had as an academic or a Fed watcher was just to sort of focus on one aspect of what the Fed does, which is setting the policy rate and the path of the policy rate. You know, now that I'm inside the building, I now realize the range of other important policy decisions that the Fed has to make, in particular, as they involve regulation, liquidity in financial markets, the transmission of policy. So there are a lot more moving parts than I think appreciated as an academic to just focus on one piece of that issue.
So actually, when I think about that, I mean, obviously this is a group that's attuned to bank examination and policy. So I mean, how do you go about allocating your time among, everybody focuses on the monetary policy function, but how much do you spend on time on each, and how do you think about that?
Well, as I said, I've only been in the job for about 2 months, so initially I've been spending a lot of time on sort of non-monetary policy issues as I'm being briefed and getting aware of a lot of the other things that are going on inside the building. My primary focus is and will continue to be on the monetary policy piece. Randy Quarles, who you mentioned earlier, is obviously our Vice Chair for Supervision, but I interact a lot with Randy and his staff, and of course, to understand the transmission for policy, I also need to understand the regulation and supervision aspects of it as well.
Actually, I was going to ask about that. I mean, you were a Vice Chairman for Supervision. You were unspecified. I mean, what does it mean to be a Vice Chairman without a particular portfolio in your current role?
Well, the portfolio really is working with Chair Mallon, the other governors, and really the Reserve Bank presidents on the process of formulating and communicating our monetary policy. The Chair Powell has asked me to be the chair of a subcommittee on Fed communication. That's a subcommittee that's been in place for about 15 or 20 years, traditionally chaired by the Vice Chairman. And we just announced last week that one of the focuses of the FOMC in 2019 will be to conduct an assessment of our monetary policy strategy communication. So I will be really focused on that effort.
Actually, you just had a fair amount to say about that monetary policy strategy and communication, and the role of data defense in it.
Yeah.
I mean, your remarks today, I mean, do you see that as a significant change, or has sort of the notion of a preset course always been sort of strong?
I think that if you go back, and of course I was not at the board in 2015, if you go back to the decision to begin raising rates in December of 2015, the policy rates had been essentially at zero for many, many years. And although there were probably a range of views on the committee even then about the ultimate destination for policy, everyone agreed that it was important to get off zero. So the way I think about this is that as you move further away from zero, and as you move towards the range, the vicinity of estimates for the ultimate destination, that I just think it's intuitive that you need to become more data dependent. Certainly I would not characterize my thinking as monetary policy on a preset course. And that's why today I chose to emphasize the importance of data dependence given where we are right now.
Well, speaking of where we are right now, obviously the lingering question is rates. So, obviously there are concerns on both sides, too soon, too late. So, I mean, how do you feel about, what are the key variables you look at in determining whether you're behind the curve or maybe ahead of the curve?
Sure. Well, I think you look at several. First of all, although the Fed focuses on 2% inflation, importantly, we also focus on inflation expectations. And those are imperfectly measured. There are surveys, there's the TIPS market. And I look at a wide range of estimates because certainly there can be shocks to the economy that push inflation temporarily above or below. But I'm really focused on inflation expectations not only being anchored, but at 2%. Also, I would also point out that as I did in my remarks, the FOMC's estimates of full employment have been drifting down over time, as have the estimates of R-star. So the committee has been in a process of learning. Those are key inputs to policy, but they're unobserved. And so I think in that instance, you need to look at a very wide range of not only real but financial market data to get a sense of where you are operating relative to that long-run destination. So I think you cast a wide net far beyond just looking narrowly at inflation and unemployment.
So there's also, I think, reportedly a real reconsideration going on at the Fed, not just about where rates should go and the strategy, but actually how to affect you.
Yeah.
Which gets to the size of the balance sheet,
yeah.
And whether to return to a corridor system, say, or a floor system. Can you talk a little bit about that? That obviously has some implications for regulation,
yeah.
Particularly liquidity regulation, but if you could just give us a sense of how all those things interact, that'd be helpful.
Great. So let's talk first about the balance sheet and then about the operating framework for influencing short-term interest rates. So under Chair Yellen's leadership, and I said so at the time, I think that the Fed put in place a very effective and well-communicated plan to shrink the balance sheet that has been ongoing now for more than a year. And it has been very well, I think, internalized and understood by the financial markets. And certainly I believe, and I think my colleagues believe, that we want to operate with the smallest balance sheet possible in order to achieve and implement our policy objectives. Now, that being said, and I'm sure everyone in your audience appreciates, we're not going back to the size of balance sheet we had before the crisis. If for no other reason, the demand for currency, which is one of our primary liabilities, is approaching $2 trillion now. So we're not going back to a $700 million balance sheet. Secondly, of course, and as everyone in this room certainly appreciates, is that there have been significant changes in financial regulation as regards to so-called high-quality liquid assets and liquidity coverage ratios. And that means that we are going to be in a world in which financial institutions are either going to be required or going to want to hold a lot more liquid assets. And obviously reserves at the Fed are a very desirable liquid asset to meet those obligations. And so the balance sheet continues to shrink along the path that the Yellen Fed began and that the Powell Fed is continuing. But I think it's fair to say that we're learning about the system, we're learning about the demand for reserves in the system as the balance sheet is shrinking. And that is a process that is continuing, will continue into 2019. Now, in terms of the way that it interacts with other parts of the financial system, right now there are obviously abundant excess of reserves. And in that situation, the excess supply of reserves is going to be an important factor that influences a variety of short-run policy rates. And obviously, the interest on excess reserves is one of the instruments that we use. In my 2 months at the Fed, we are discussing and thinking about the pros and cons of different approaches, and that's a process that's ongoing. Right now, the current system, I believe, serves us well. We have good control over the policy rate and keeping it within that range.
I guess to some extent that goes back to the first question. It does seem, I think it might have been a time at the Fed where supervision and monetary policy were more siloed.
Yeah.
But it sounds like with Vice Chairman Quarles, perhaps there's more interaction on that front.
I can't speak to prior experience, but there's a lot of interaction now. Yes.
And maybe just one more question in closing. We really appreciate your coming up.
Of course.
Because we're so early in the tenor. There's been a lot of talk about recently about Fed independence and the importance of Fed independence. But I just want to know, what does that mean to you? What does it mean for the Fed to be independent as opposed to perhaps to insular?
Okay, well, the Fed's mandate is provided in statute, the Federal Reserve Act and various amendments to it, and our mandate is to achieve full employment and price stability. And so, as a student of monetary history, I understand that not just the Fed, but around the world, that central banks that have a degree of independence over setting their instruments achieve better outcomes over time. The Fed is accountable, it should be accountable, it should communicate why it's doing what it's doing. And so I do believe that our operational independence is important. Now, that being said, monetary policy is more of an art than a science, and there can be a range of opinions about the pace and destination for policy, and I respect that. But certainly, my focus, and I'm sure my colleagues' focus, is really on identifying and implementing a monetary policy that best achieves those objectives given to us by the Congress.
Well, with that, thank you. Seems we're in good hands. Thank you, Baer. Thank you so much for your